a reliable store of value, means of payment, unit of account. The problem being that different people in the room will object to all three of them, which you won't agree, I suspect, on which one is not ready. Currently, of course, pessimism is most pervasive about the euro. It's not clear that the crisis countries in Europe, now being forced to impose draconian spending cuts, can recover without reintroducing their own currencies, or so it's argued. Doing so would enable them to devalue those currencies and grow their exports. Keeping them in the euro area, on the other hand, would require massive transfers from Germany to Southern Europe, and German voters, it is argued, would rather abandon the euro and see the reintroduction of the Deutschmark than agree to this. So I will insist this afternoon that all this euro doom and gloom is overdone, while a Greek or an Irish default on their government debt cannot be ruled out. Neither can a default by Los Angeles County, or more to the point at the moment, Nassau County, New York. But in the same sense that a default by Los Angeles County on its debt, on its bonds, would not mean the end of the dollar. It would not mean the introduction of a Los Angeles peso as the alternative to the dollar. A Greek default would not mean the end of the euro. Moreover, Greece would almost certainly make its problems worse by attempting to reintroduce the drachma. I suspect we'll want to talk about that a little in the Q&A, but let me leave that for the moment as an assertion. Germany, I think, for its part, has too much invested in the European project to turn its back on that now, which is what Germany abandoning the euro would mean. I would observe also that while there is lots of popular opposition to the euro in Germany, there is very, very strong support for it in the business community and the banking community alike. Germans imagine a world with a Deutschmark that went through the roof relative to the other European currencies were it introduced. Germany's whole economic strategy for the last 10 years can be summed up in one word: export. And they wouldn't have been able to do that without the euro. So I think the euro is here to stay, but that doesn't mean that it will automatically become an international currency of the first rank. For that to happen, Europe needs to complete its monetary union. So a simple way to put it is that the euro area has shiny coins and beautiful banknotes. They have a good central bank, but they don't have the other elements of a properly functioning monetary union. The first thing they need is bank regulation at the euro area level. They have even more bank regulators than we do in the United States, and even worse, they're geographically based. So German bank regulators don't give a hoot for what bad bank regulation in Germany does for the rest of the euro area. And indeed, it is the fact that the German banks are weak, which rules out the possibility of debt restructuring by Ireland and the southern European countries. Europe needs a properly functioning emergency lending facility. It has a small temporary one, which needs to be enlarged and made permanent. So I think it's possible to put these elements in place. I suspect Europe will put them in place this year. The crisis, once again, is coming faster than they anticipated. Whenever the European Union has faced a crisis, it's been confronted with the question of whether to go forward or go back. For more than 50 years for more than 50 years now, when confronted with that problem, it has gone forward. So the father of European integration, Jean Monnet, the French technocrat, said, Europe is forged in crises. He meant that whenever a crisis comes, Europe goes forward. Jacques Delors, the French father of the single European market, said recently Europe needs to rediscover its soul, by which he meant deepen the integration process. And my guess is that this is precisely what it will do. Then, of course, there are the challenges facing the dollar. And those are, I think, are fundamentally fiscal and at a deeper level political. So the problem, in my view, is dysfunctional politics that continue to undermine efforts to bring our chronic budget deficits under control. Divided government for the next 2 years is not going to make that easier. Federal government debt in the United States is virtually at the level of 75% of GDP, of national income now. For a federal government that only mobilizes 19% of national income in the form of taxes, in good times, 75% of national income debt is a very high level. It means that something approaching a quarter of all the taxes we pay will go for debt service as once interest rates return to normal levels. And you will know that the fiscal outlook only darkens after that as baby boomers begin to retire in large numbers and the healthcare curve, cost curve, remains unbent, if you will. Those problems are still out there, and they will only get worse. So I think the question boils down to, will the United States come to grips with these problems before they get out of hand? And if not, the hot potato will end up in the lap of the Fed, which will be reluctant to raise interest rates when inflation rears its head, and inflation will be the way we will square the circle. I think the fact that foreigners now own a majority of U.S. Treasury securities makes it more likely that measures to inflate away the debt will be seen as politically expedient. But the point is that foreigners understand these incentives. They see as well as any of us the possibility of this scenario. If they see the United States unable to solve its fiscal problem, they will dump their dollars. So to be clear, I'm an optimist about my country. This is not my baseline scenario. The United States has repeatedly shown itself capable of dealing with significant challenges. We may successfully do so again, but if we don't, this would spell the end of the dollar's role as an international currency. So what would that mean? That would mean that one morning the bond market vigilantes would be back. I think we've seen in Europe how bond markets can be quiescent and calm and interest rates can be low for a long time, until one morning when everyone awakes with a start and realizes that other people are getting out of the market, and they all then scramble out. So there is a scenario, I think, in which one could see a dollar crisis, a dollar crash, if you will, a mass migration away from the dollar. What would that mean if foreigners lost confidence in our currency? It would mean higher borrowing costs for the U.S. government and more generally for corporations that need to borrow in order to fund investment projects. It would mean a weaker currency. The kind of calculations I do in the book suggest a dollar that would be 20% weaker in effective terms. So that would mean higher prices at Best Buy and the like for those imported flat screen televisions. It would mean that we couldn't finance our external deficit as freely and easily as we have in the past. If I total up the different costs involved, I get about 3% of national income as the cost to the United States in this extreme scenario of the dollar losing its exorbitant privilege. That's 1% of economic growth. 1 year of economic growth in the United States in good times. So that's not a catastrophe for the U.S., but if you compare the recession year with what we're going into now in 2011, it makes a big difference. Finally, having talked a little bit about the euro and about the renminbi and about the dollar, let me talk about the Chinese renminbi. I think China will clearly have to surmount very significant challenges in order to internationalize its currency, to make its currency attractive to international investors. It will have to build deep and liquid financial markets. It will have to make them accessible to foreigners, which they are not now. It will have to remove many of the financial restrictions that are integral to its development model. If it will be open to inflows and outflows of finance, it will have to let its currency fluctuate more freely as a cushion against the effects. It will have to establish rule of law in order to gain the confidence of international investors. So these are clearly not processes that can be completed overnight. That said, I think many people are still underestimating how intent Chinese officialdom is about moving in this direction. And I think many people are underestimating how quickly it's possible to move. So a lot of the book is economic history. Let me give you a historical precedent for China's stated objective, which is to make Shanghai an international financial center and its currency a true international and reserve currency by 2020, less than 10 years from now. And the historical precedent is from the United States. In 1914, the dollar was not an international currency. The dollar was used to invoice and finance exactly 0% of global trade. The dollar was used to invoice and finance about 0% of U.S. imports and exports as well. When American importers and exporters needed trade credit, they asked their bank, and their bank asked a correspondent in London, because London was the international financial center, and the pound sterling was the dominant international currency. The dollar accounted for exactly 0% of the foreign exchange reserves of global central banks and governments. The dollar accounted for 0% of the international bonds that other countries issued. That changed in exactly 10 years. By 1924, in fact, the dollar had matched the pound sterling as an important international currency, and some of these realms marginally overtaken it. What did we do? Well, we established a central bank called the Federal Reserve System in 1914 that could provide liquidity to U.S. financial markets. And one of the things the Fed set out to do was to internationalize the dollar, to create markets and trade credits and the like in order to advantage U.S. companies and exporters. U.S. exporters previously had basically had to pay two commissions, one to their local bank and then the one charged by the foreign correspondent in London to provide the trade credit. U.S. exporters had to bear the risk involved if the exchange rate between the dollar and sterling moved. And they complained about that a lot. So one of the motives of Nelson Aldrich, the senator from Rhode Island, and Paul Warburg, the banker from New York, who conspired to draw up the blueprint for the Federal Reserve System at a meeting in Jekyll Island, Georgia in 1910, was precisely in order to internationalize the dollar and change this state of affairs. The Fed set out to create this market in trade credits and internationalize the dollar, and it did so quite successfully in the span of 10 years. So you all know that this is a very particular historical period, 1914 to 1924. Other things intervened and worked to the dollar's advantage, like a big war in Europe. But I think this fact of institutional innovation and a whole set of policy initiatives designed to internationalize our currency is, in fact, a history that Chinese officials are aware of. And they are, at the moment,